Hello, everyone. Welcome back to our channel. Today we'll guide you to margin trading, which is an important strategy that traders should know. Margin trading in investing is a risky strategy that offers potential gains and increased risks. It allows investors to borrow funds from brokers to enhance their investments. But this can lead to losses that exceed their initial investment, potentially leaving them in debt to the broker. This video will help you explore the mechanics, risk, and reward of margin trading. First off, let's talk about what is margin trading. Margin trading, also known as buying on margin, it enables investors to make larger investments using borrowed funds alongside their own capital. This practice increases the potential for higher returns, but also exposes investors to greater risk of significant losses. When setting up a brokerage account, investors can typically opt for a margin account, where assets purchased serve as collateral for the borrowed funds. Regulations generally permit borrowing up to half of the investment's purchase price, although specific broker limits may apply. Next, let's move on to the process for trading on margin. Margin trading involves borrowing funds from a broker to trade financial assets, thereby enhancing potential returns. To begin, you need to open a margin account with a brokerage, requiring an initial deposit called the initial margin. Once set up, you can borrow money to purchase securities, typically a percentage of the purchase price known as the margin requirement. This borrowed amount that, combined with your own funds, allows you to control a larger position in the market. However, borrowing incurs interest, impacting potential profits. Margin trading amplifies gains, but also heightens the risk of significant losses. If the value of your securities drops below a certain point, the broker may issue a margin call, requiring additional funds or the sale of securities. Now, let's look at the components of margin trading. Margin trading is closely monitored by regulatory bodies like the Federal Reserve, FINRA, and the SEC, with standardized guidelines applying across brokers, including three key components. First, minimum margin. It is the lowest initial deposit required to start trading. It's typically $2,000 or the total cost of the securities, whichever is less. However, some brokers may require a higher amount. Second, initial margin. It is the portion of the asset's purchase price funded by your own money. According to Regulation T, you can borrow up to 50% of the stock's initial cost, though brokers may set higher limits. And the last one is maintenance margin. It is the minimum balance required in your margin account once you hold securities on margin. It's generally set at 25%, but brokers may enforce higher percentages. Sometimes it's up to 40% to mitigate debt risks. This safeguard aims to prevent excessive losses. Next, let's move on to see the benefits of margin trading. Margin trading offers several benefits, including: first, leverage. Margin trading amplifies your buying power beyond what you could achieve with cash alone. While cash accounts require full funds for purchases, margin accounts allow you to acquire more assets using borrowed funds. Second, flexibility. Unlike traditional loans, margin accounts lack fixed repayment schedules. You can repay the borrowed funds whenever you choose to sell the securities, helping you meet maintenance margin requirements set by the broker. Lastly, profit amplification. Margin trading can significantly increase potential profits. As the value of your securities rises, not only does their worth increase, but the rising value also provides additional leverage for future margin trades, which potentially enhancing earnings. However, margin trading also comes with significant risks. Here's the risk of margin trading that you need to know. First, increased losses. While margin trading can amplify gains, it also exposes you to higher losses. If the assets purchased with borrowed funds decline in value, you could lose your initial investment and still owe the broker for the borrowed amount. Second, margin calls. When the value of your assets falls below the broker's required maintenance margin, you will receive a margin call. This requires you to deposit additional funds into your account to meet the minimum margin requirements. Failing to do so can lead to financial instability and forced liquidation of assets. Next, interest costs. Borrowed funds incur interest charges, which can vary based on the broker and market conditions, typically between 4.75% to 12%. Interest accrues regardless of whether your investments perform well or poorly, impacting your overall returns. Lastly, forced liquidation. If you fail to meet a margin call, your broker may liquidate your assets without your consent to cover the debt. This forced liquidation can result in substantial financial losses and further complicate your financial situation. Margin trading involves borrowing funds to buy or sell assets, thereby increasing potential profits and losses. While it enhances buying power, it carries significant risks. It's essential to use funds you can afford to lose and be prepared for unexpected events like margin calls. Despite risks, margin trading can diversify investment portfolios and appeal to many traders seeking broader opportunities. After watching this video, we hope you understand more about one of the popular trading strategies like margin trading. Remember to do more research on this strategy before making the decision on trading. Do not forget to like, share, and subscribe our channel on YouTube or follow our social media below for more insightful content. And see you in the next video.